Today, we're breaking down AVEM, the Avantis Emerging Markets Equity ETF, an actively managed fund designed to provide long-term capital appreciation by targeting emerging market stocks with favorable fundamental characteristics. This is not a traditional market cap-weighted emerging markets ETF, and that difference is the entire point. AVEM is actively managed and seeks to outperform the MSCI emerging markets IMI index by emphasizing companies with strong profitability and lower valuations, while de-emphasizing expensive, low-quality names. Instead of simply owning the largest companies in each emerging market, AVEM tilts the portfolio toward areas where expected returns are higher. One of the most important features of AVEM is its small-cap emphasis. Emerging markets are often dominated by large state-owned enterprises and mega-cap firms that may have weaker profitability, higher leverage, or political influence. AVEM intentionally underweights those large-cap names and allocates more capital to smaller companies that demonstrate stronger balance sheets, higher profitability, and more attractive valuations. This small-cap tilt is a major source of potential outperformance, but it also introduces additional volatility. AVEM evaluates stocks using multiple factors, with a strong focus on profitability and valuation. Companies with higher operating profits relative to their size and lower price-to-book ratios tend to receive higher weights, while companies with weaker fundamentals are either underweighted or excluded. This approach reflects Avantis's belief that fundamentals matter over long-time horizons, especially in less efficient markets like emerging economies. The fund invests broadly across sectors, industries, currencies, and emerging market countries. Rather than making concentrated country or sector bets, AVEM maintains wide diversification while allowing the factor tilts to drive portfolio construction. This helps reduce reliance on any single country, commodity cycle, or political regime. Another key distinction is that AVEM is not trying to time markets or make macro calls. The strategy is systematic and rules-driven, even though it is actively managed. Portfolio decisions are guided by a consistent framework rather than short-term forecasts. That makes AVEM more predictable than discretionary active funds, while still offering a meaningful departure from traditional index exposure. Compared to standard emerging market ETFs, AVEM may look very different. You'll typically see less exposure to mega-cap Chinese internet companies, large financial institutions, and state-controlled energy firms. In their place are smaller, more profitable companies that may benefit from domestic growth, improving governance, and expanding middle classes. That said, this approach comes with trade-offs. Small-cap and value-tilted emerging market stocks can experience deeper drawdowns during periods of global risk-off sentiment. Currency volatility, political risk, and liquidity constraints can all amplify short-term moves. AVEM is designed for investors with a long-term horizon who can tolerate higher volatility in pursuit of higher expected returns. Bottom line, AVEM is a thoughtfully constructed emerging markets ETF for investors who want more than simple market cap exposure. By emphasizing profitability, valuation, and small-cap companies, AVEM aims to capture structural return premiums that traditional emerging market ETFs often miss. It works best as a core emerging markets allocation for investors who understand factor investing and are willing to stay patient through cycles. If this breakdown helped, subscribe to the ETF Investor and let me know in the comments. Do you prefer broad emerging market exposure, or do you want an active fundamentals-driven approach like AVEM?